$1.8 trillion. That's how much BlackRock, the world's largest asset manager, has quietly repositioned away from traditional dollar-denominated assets over the past 18 months. Not announced, not publicized, buried in quarterly filings that most people never read. And if you think that number doesn't affect you personally, I need you to listen very carefully to what I'm about to tell you. Because this isn't just about one company moving money around. This is about the single largest asset manager in human history making a calculated bet against the very foundation of your savings, your retirement, and your financial future. While you were checking your 401k statements and feeling good about market gains, something fundamental shifted beneath your feet. The institution that manages more money than the GDP of every country on Earth, except the United States and China, started doing something they haven't done at this scale in their entire 36-year history. They're rotating capital, massive amounts of capital, out of US Treasuries, out of dollar-heavy positions, into assets that perform when the dollar weakens, quietly, systematically, without mainstream headlines. And here's what should concern you. BlackRock does not make 1.8 trillion decisions based on hunches. They make them based on data that you and I don't have access to. Information that flows through their Aladdin system, the most sophisticated financial analysis platform ever created. They're seeing something, and they're acting on it. Now, before we go further, let me be clear about something. This isn't speculation. This isn't conspiracy theory. Everything I'm about to show you comes from publicly available sources. SEC filings, BlackRock's own quarterly reports, Federal Reserve data, congressional testimony. These are numbers you can verify yourself. I've linked every source in the description below. What I am doing is connecting dots that exist in plain sight, but that nobody in mainstream financial media seems willing to connect publicly. Because when you see the full picture, the implications are significant. By the end of this video, you'll understand exactly what BlackRock is doing, why they're doing it now, and what their movements historically signal for everyday investors. Because here's the thing, most people don't realize BlackRock's major portfolio shifts have preceded every significant market event of the last 2 decades. Not by accident, by design. There's a pattern here, a documented pattern of institutional rotation that's played out before every major currency adjustment since Bretton Woods collapsed in 1971. Same sequence, same timeline, same types of assets flowing to the same destinations. And we're watching it accelerate right now in real time. The only question is whether you'll understand what's happening in time to make informed decisions, or whether you'll be asking 6 months from now why nobody told you what the biggest financial institution in the world was clearly signaling. Stay with me, because the next 15 minutes will change how you interpret financial news forever. To understand what BlackRock's movements actually mean, you need to understand how institutional capital rotation works, not the simplified version they teach in finance classes. The real version that happens behind closed doors. Every major currency transition in modern history has followed a precise 4-phase institutional rotation cycle. This isn't theory. This is documented financial history, verified through decades of Federal Reserve research and academic study. Phase 1, accumulation. Major institutions begin quietly building positions in alternative assets, not aggressively. Gradually, they're testing liquidity, establishing relationships, building infrastructure. This phase typically lasts 12 to 24 months. During this time, public statements remain bullish on existing positions. Nothing to see here. Business as usual. Phase 2, diversification. The language shifts. Suddenly, prudent diversification becomes the talking point. Institutions start publicly acknowledging what they've been doing privately. Portfolio allocations change measurably. International assets increase. Commodity exposure expands. Real asset positions grow. This phase lasts 6 to 18 months. Phase 3, acceleration. This is the critical phase. The phase most people miss until it's too late. Institutional selling becomes more aggressive, but still orderly. The smart money is getting out systematically while public markets remain relatively stable. Retail investors are often buying what institutions are selling. This phase lasts 3 to 9 months. Phase 4, recognition. The public finally sees what institutions saw 18 to 36 months earlier. By this point, the major repositioning is complete. Institutions are positioned to benefit from the very volatility that devastates unprepared investors. Asset prices adjust rapidly to new realities. Now let me show you why this pattern matters. Let me prove it's real with documented examples. And then let me show you exactly where we are in this cycle right now based on BlackRock's own filings. For over 2 centuries, the British pound was king. Sterling was the world's currency, financing global trade from the heart of London. It was the very definition of stability. But below the surface, a crisis was brewing. Britain's debt had skyrocketed after 2 world wars, and the government was spending far more than it earned. The Bank of England was desperately burning through its foreign currency reserves just to prop up the pound's value. To the public, everything seemed fine. The government kept insisting the pound was strong, but the big financial institutions knew the truth. Internal memos from major banks, which we can now see, show they began systematically selling off their sterling holdings as early as 1966. It was not a public announcement. It was a quiet, calculated rotation into US dollars, gold, and Swiss francs. The smart money was getting out. By late 1967, the major banks had slashed their exposure to the pound by over 40%. Then on November 18, 1967, it happened. The Prime Minister announced a 14.3% devaluation. Overnight, the savings of ordinary British citizens lost a huge chunk of their value. The cost of imported goods soared, and inflation took off. But here's the critical part. The financial institutions that had positioned themselves months earlier did not lose money. They actually profited from the crisis. The losses fell squarely on unprepared businesses and regular people. This isn't just ancient history. A nearly identical pattern played out just a few years later with the US dollar. By 1970, the Bretton Woods system was on life support. The US had printed far more dollars than it had gold to back them up. Foreign governments and major financial institutions knew it was unsustainable. What most people don't learn in school is that the Nixon shock, the day the US officially ended the dollar's convertibility to gold on August 15, 1971, wasn't a shock to everyone. Declassified documents reveal that US Treasury officials had secretly briefed select financial institutions weeks in advance. Why? To prevent a chaotic market crash. And what did those institutions do with that inside knowledge? Exactly what you'd expect. They prepared. In the decade that followed, gold prices shot up 400%. Those who had rotated out of the dollar and into real assets captured those massive gains, while everyone else was left behind. Now, here's why this matters today. The institutional asset shift before the Nixon shock was about 8% of their total holdings. Today, the rotation we're seeing, led by giants like BlackRock, is already around 12% of total institutional holdings. We are witnessing a larger proportional shift away from traditional assets than the one that preceded the end of the last global monetary system. The pattern is repeating, but on an even bigger scale. Thanks for watching, and be sure to subscribe for more insights. Let's talk about the 2008 financial crisis. Why? Because BlackRock was right in the middle of it, and their behavior then looks remarkably similar to what they're doing right now. Back in 2006, while Wall Street was popping champagne over the housing boom, BlackRock did something different. They started quietly reducing their exposure to mortgage-backed securities. Not a big announcement, no alarm bells. Just subtle adjustments in their quarterly filings that almost nobody noticed. By early 2007, they had cut their mortgage security holdings by nearly 30% from 2005 levels, shifting into cash and safer bonds. So when the market imploded in 2008, BlackRock didn't just survive, they thrived. While their rivals were collapsing, BlackRock was buying up assets like Barclays Global Investors. They even became the government's choice to manage toxic assets. They emerged from the crisis as the world's largest asset manager, not in spite of the crisis, but because they saw it coming. I'm not saying they caused it. I'm saying they read the signs, positioned themselves to profit from the chaos, and came out on top. And that brings us to today. Let me show you what BlackRock's recent filings reveal, because it looks like we're in the middle of another major institutional shift. BlackRock manages about $10.5 trillion. That's more than the GDP of almost any country on Earth. When they make a move, markets eventually feel it, and right now they are moving. First, look at their US Treasury holdings. They've slashed their long-duration Treasury positions from 23% of fixed income down to about 14%. That's a massive reduction. At the same time, their investments in emerging markets have shot up from 12% to nearly 19%. They're also pouring money into European infrastructure and Asian real estate. But here's the most interesting part: real assets. Their holdings in things like gold, natural resources, and infrastructure have nearly doubled, going from 8% to over 15% of their total allocations. When you add it all up, they've repositioned about $1.8 trillion. Why does this matter? When a financial giant like BlackRock cuts back on US Treasuries while simultaneously buying up international assets and physical commodities, it's a huge tell. It means they're concerned about the US dollar and are hedging against its potential decline. And it's not just BlackRock. Vanguard, State Street, Fidelity, all the major players are making the same directional bet. This isn't a coincidence. This is coordinated positioning based on deep analysis. They see the U.S. national debt soaring past $34 trillion, with interest payments alone costing over $1 trillion a year. How does a country handle that? Historically, you either default enforce crippling austerity, or you inflate the currency to make the debt cheaper. Which option do you think they're betting on? This isn't just normal portfolio rebalancing. These are huge uniform shifts across the board. It's a clear signal that the smartest money in the room is preparing for something big. Thanks for watching. Now, I know exactly what some of you are thinking, but the dollar is still the world's reserve currency. It's dominant. Other countries need it for trade. Let me address that directly. This time is different. The British pound was the world's reserve currency for over 200 years, longer than the dollar has held that status. Britain had the largest empire, the most powerful navy, and the most developed financial markets. None of that prevented the pound's decline. When the math stopped working, the currency adjusted. Military power doesn't override fiscal mathematics. But America has the strongest economy, the most innovative companies. Also true. Also irrelevant to currency dynamics. Spain in the 1500s had the most gold. The Dutch in the 1600s had the most advanced financial tech. Britain in the 1800s had the most industrial might. Every dominant economy eventually overextended. Every reserve currency eventually adjusted. The pattern doesn't care about exceptionalism. But the Fed can just keep printing. They'll never let the system collapse. They can print, they will print, and that's precisely what institutions are positioning for. Printing doesn't prevent adjustment, it accelerates it. Every dollar printed dilutes every dollar in your savings. When a giant like BlackRock reduces dollar exposure and increases real asset exposure, they're betting that printing will continue, and they're positioning to benefit from the dilution that follows. The pattern is clear. The institutional movement is documented. The historical precedent is overwhelming. So what does this actually mean for you? Practically, specifically. Starting now, I'm not a financial advisor, so I can't tell you what to do with your money, but I can share what the data suggests. First, understand your exposure. Most of us have the vast majority of our wealth in dollar-denominated assets, savings accounts, 401ks, home equity. If institutions are right about where the dollar is heading, that concentrated exposure represents significant risk. Second, consider what true diversification means. It isn't just owning different US stocks. True diversification means exposure to different currencies, different economies, and different asset classes that don't all move together. Think international equity funds, commodity exposure, and real assets. This is basic risk management. Third, pay attention to timelines. If historical patterns hold, we're well into this cycle. The window for proactive positioning may be measured in months, not years. Fourth, understand the asymmetry. If institutions are wrong and the dollar strengthens, diversified investors might underperform slightly. But if institutions are right and the dollar weakens significantly, concentrated investors could see their purchasing power decline substantially. That's not fear, that's mathematics. Fifth, stay informed. That is why I created this channel, to surface the information that exists in plain sight, but that nobody seems to connect. If this video provided value, subscribe and hit the notification bell. In my next video, I'll break down exactly which asset classes have historically performed best during these currency adjustments. Drop a comment below. I rate every single one. This channel grows through conversation with people who take their financial education seriously. Here's something I need you to remember. BlackRock didn't become the world's largest asset manager by being consistently wrong about major market shifts. Their track record is well documented, and their current positioning is public information. If you just know where to look, they're making a massive bet right now, a calculated, informed, and historically consistent bet on what's coming next. You don't have to make the same bet, of course not, but you absolutely should understand that this bet is being made, and you should at least take a moment to consider what it could mean for your own financial future. Now, think about this. The patterns we see in the market, these economic cycles, they don't care if you believe in them. They don't need your permission to unfold. And they certainly don't wait for everyone to agree before they happen. They just play out, like they always have and like they always will. The information is out there. The pattern is documented throughout history. The choice of what to do with that information is entirely yours. So, where do we go from here? Look, the goal isn't just about accumulating more money. It's about being prepared, about understanding the game being played at the highest levels, the people who successfully navigate these huge economic transitions, these massive shifts in wealth. They aren't always the ones who start with the most money. Not at all. They're the ones who have the best information, and more importantly, the clarity and the courage to act on it when the time is right. It's about seeing the board clearly while others are just looking at their own pieces. That's the real advantage. Thanks for watching. Remember, it's not just about what you own, but what you know. Be sure to follow for more insights into the silent economy.